Hey everyone, Mitch with Bull and Bear Investments here with Austin and Seif. We're excited today to record the webinar for the STR Fund 2. And so we have Seif on the line here, who's one of the founders of TechVestors. He does all the heavy lifting on the back end. So real excited to get the scoop from him. So I want to kick it right off to him to get started.
Thanks, Mitch. Yeah, I'm excited for round two. First fund is going off really well. And we were all kind of joking a little bit before because we're about to pass $1 million in distributions for first fund. And I can say that now because by the time this recording goes out, that'll be public knowledge. But look, for those of us who didn't see STR1 and got a little bit of what that is, the big idea is making short-term rental investing real damn easy, right? Making it simple, making it passive. It's a job if you go do it yourself. You have to find the property, design the property, operate the property, and a lot of the headaches that come with it. And typically that's going to dissuade you to actually get involved. But now with our partnership with Bull and Bear, you're able to invest passively in the fund where you can simply place some capital and let us do all the heavy lifting, as Mitch kind of mentioned. So you probably have the money, you lack the time, you lack the energy, or you may just don't want to do it yourself, but you get all the benefits of direct real estate ownership, right? So none of the work, you get this quarterly distributions coming right to your bank account. You benefit equally pro rata from the growing appreciation. You get 100% of the tax benefits. Two of my favorite benefits of investing passively as an LP, and really in anything, but especially in an asset class like this, where it's not really easy to scale by yourself, is you have zero liability with loans and lending, and you get instant diversification, right, in your portfolio with as little as 50 grand, right? Like you just can't get that in any other asset class, or just by doing it yourself, unless you have 8 figures worth of money. So that being said, I think those are some really strong points. And over these next 4, 5, 6 years, which is our projected hold period, really the journey in 30 seconds is we're going to buy a bunch of single family homes, right? In our first fund, we bought over 75. All across the country, across different geographies, different seasonalities. We're going to design them really freaking well. We're going to stabilize them and drive some really great cash flow while we hold them. And then we're eventually going to package them up like a 6-pack of muffins at Costco, right? And then we're going to sell them to someone who's buying the aggregate portfolio based on the revenue of that business. So a single short-term rental sells at some X premium. 100 of them or 200 of them will sell for a much larger premium because it's harder to attain that scale. And that's exactly the sweat equity that we're putting in today. And as mentioned, we did this in our first fund, of which Austin, Mitch, and I, and the entire team across the board were a part of. We raised over 37 million. We drove 71% more revenue than our competition as of our Q4 data, 41% more occupancy. We are the institutional option in this space. Right? We are the big boy, the BlackRocks, the Blackstones, right? In this space against the moms and pops that we compete against. Not only that, we also recognized 8 exits in our first fund, proving that not only could we buy based on values, we could actually exit based on revenue, which is exactly the same business thesis and strategy that we're employing in our second fund, just a much larger and bigger scale. So as you can see here, we averaged a 42% IRR there. That is not the target. And I think that's a fantastic number, but I think we'll do reasonably well moving forward. So as what's to expect in Fund 2, I like to think of it as a bell curve, right? Or a sandwich. At the beginning of any real estate that you do, you're not getting into real estate to get rich quick. You're getting into real estate to get rich guaranteed, as the old adage says. And what we're going to do is we're going to stabilize at the beginning. We're going to find these properties, design them, get them to market, get them to revenue. And then in those middle years, we're going to drive really great yield. And then we're going to eventually disposition, sell them, right? We could sell them off technically 1 at a time, 10 at a time, or 250 at a time, right? And those are all things that we can certainly consider. So, as a leader, I would be hard pressed not to talk about what I think is one of our biggest competitive edges, which is we have the best team in the space, right? We have key advisors from places like AirDNA, Bigger Pockets, Realtor.com. Our team comes from places like Picasa and DR Horton. We built our own proprietary technology, right, that allows us to find and discover properties. We underwrite over 100,000 properties a month, and it's not our first rodeo. So with that being said, right, the rest of this presentation is going to predominantly go over the asset class. We're going to talk about the story, the track record. We're going to talk about team technology. We're going to talk about money, how we protect it and how we make it. right? And those are going to be some really important strategies as well. But it's also really important to think about what happens at the end, right? Like why you should consider getting into this if you're thinking about it from a financial perspective. So these are some targets. The idea is to double your money or so every 4 to 6 years. We want to earn some really great cash flow and specifically tax advantaged and deferred cash flow. We want it to be passive, right? And we want that diversification of an asset class that's historically hard to diversify. And that asset class is short-term rentals. Our society prefers that. I'm a father of two under two, and I can't tell you what it's like taking kids to a hotel. Never do it again in my life. But taking them to an Airbnb is a lot more different. We have amenities like a kitchen, space, right? And that's just a family of four, let alone if we're going with a group, right? And so most of the homes we target are 4 bedrooms and larger with really big amenities like hot tubs, mini golf, pickleball courts, basketball courts. You don't get that inside a hotel, let alone for the price that you get it for an Airbnb. If you guys have ever gone with a group of 10 to a hotel, two to a room, $200 a night, what is that? $1,000 a night for us, like we're going to compete easily on price. We're going to compete on amenities and we're going to compete on privacy, not to mention the tax benefits of ownership, the cash flow of ownership and everything in between. So while you see hotels here, we don't compete with them. They're just representative of the hospitality industry in aggregate. Not to mention demand, right? None of us want to invest in something that's dying. Data tells us that STRs are in fact growing and growing aggressively. We've seen it three times the adoption here over the last decade, especially after the pandemic. We're seeing significant scale and significant demand in terms of mobility and permanent behavior. And it's really reflective in the data, right? So in the $150 billion short-term rental industry, half of that revenue happens here stateside, domestically, which is where we invest. And every data point is indicating up, right? Demand is up, right? Booking activity is up. So booking activity stands for really just number of bookings in general. And it's not just an anomaly of a COVID year or pre-COVID or post-COVID. I mean, this is one of the best years on record in doing so. Demand also up, right? Again, no COVID anomaly here. And one of my favorite metrics to look at to kind of look at future indicators is pacing. People are not only traveling more, they're planning to travel more in advance, right? And these are all really great indicators of what we're able to do and operate. So that being said, let's talk about operating, right? We are vertically integrated, meaning we run our own management, design, scale, technology, infrastructure, and everything in-house through our third-party affiliate. And that really allows us to drive the performance and own the stack without a bunch of red tape in the way, and drive value to shareholders in kind of subsidized models. And that's because the primary competition we compete with, the moms and pops, don't have these advantages, right? You got Grandpa Bob throwing IKEA furniture in the back, not using revenue management tools, not designing it the way that he should. And while he's making a few $100 a month and he's really happy with that, that's not a sellable business, right? It's not a sellable asset. And to us, we always want to make sure it's scalable and sellable. And if you look at our performance in Fund 1, as you can see, we've really crushed it month over month. January 2022, we were only live for like 14 days, hence why you see that right under 100%. If we were live for the whole month, we would have absolutely crushed it. And we've beaten pro forma every single month since inception. We have 242 months of data now when you consider each property and how many months it's been live. We've never had a negative quarter. We've always sent out distributions every single quarter. We've never had a capital call. These are all good things you want to hear in times of fear in the market that we might be hearing today. So you can certainly play around with the deck, click on a bunch of these listings, see what they look like, see where they go, as well as kind of just like do your diligence on track record. But without further ado, Mitch, Austin, y'all have been fantastic as partners in the first fund. We're partnering again here on Fund 2. I think I'd love to hear, and I'm sure everyone else would love to hear why you guys made the decision to partner with us again.
Yeah, I mean, you said the analogy, it's not our first rodeo earlier, and I think that's really contributes to why we wanted to be a part of this again, because we really seen just from the top down, world-class service when it comes to every aspect of this business model. We've appreciated the partnership, the professionalism, and ultimately the returns for our investors. And it's been great to see their excitement. And also it's a really sexy asset class, right? Like we love showing off our before and after pictures and our design. Like it's something that we get really excited about as a team. For those of you that don't know me and Mitch, we are the principal founders of Bull and Bear Investments. For those of you that do know us, you might see a newer face here, McCain, my younger brother, which looks like a little bit of nepotism, but the reality is it's just unpaid labor. Hiring the young buck to come teach us how to do some social media and marketing and stuff. But as a team, we've done just over 1,400 units in the value add multifamily space, and then in the last few years, also offered the short-term rental funds as well as some mobile home parks, and looking for opportunities to provide our investors options to continue their investing strategy and hit their goals, even in markets that might not be as favorable as they have been in the past.
Could not agree more. And Mitch, round 2 here, we're really excited to work with you guys. And, the properties are coming out bigger and better than I think ever before. You guys have seen some great progression there. So yeah, we're excited, certainly there as well. A little bit about us. We come from tech, right? Sabrina, myself, and Sam, who's the third general partner. And we've come from places like Facebook, where we built teams, Apple, where we built the first generation AirPods, really building operational advantages and technological advantages. But we wouldn't be here today without an incredible team. Mick is our head of asset management, right? He previously ran portfolio management at places like Picasa. Josh is STR Horton. John is literally known as the Airbnb data guy, and people like Taylor, has an incredible, great Twitter. He'd kill me if I didn't tell you guys that. And a bunch of pets, of course. But we also got some really great white hair on the team. People like Scott and Jamie, who come from AirDNA. Scott founded AirDNA. Jamie's the head of research at AirDNA and head of data. So key people in key places really allow us to execute, scale, right? And really understand and open new doors. And that's a huge commitment that we have, right? Especially in times of distress, who you work with matters a lot, and how they navigate, right? In our first fund, when we first started, we thought we could just pick up the phone and call Picasa and Avantstay and some of these other firms. And while they're great, they failed, right? And if you didn't have operators you could work with, we were forced essentially to build our own operating company to service our fund, right? And many other GPs could have simply just folded, right? And said, well, I don't know what to do. I think we have a really great knack for adapting and pivoting and understanding what we need to do. And it really shows. And I think the industry also took notice, right? We've been featured on a bunch of great podcasts. If you're listening and you want to go listen in many ways in terms of the story, read about us a little bit and kind of where we are. But, a lot of this journey started with technology. And that technology today allows us to underwrite over 100,000 properties a month, to understand what to buy, where to buy it, how to finance it, all the kind of unique details of what short-term rentals look, feel, and operate. Because the data-driven decisions we make today are led by data, but they're executed by humans. Like, we are not a technology company that does real estate like a Zillow, for example, with iBuying. We are a real estate company that builds technology to guide our humans. And those are two very, very important distinctions. And we're buying in really fantastic places all across the country. We're going to continue our expansion in Fund 2 in places like Scottsdale, Memphis, the Poconos, places in Florida. We've added markets like Galena, Illinois as well, the Blue Ridge Mountains of Georgia. We're looking at Asheville, North Carolina as a predominant next market, the Hudson Valley of New York. And look, it's very simply, we go where the data tells us, right? Because as data evolves, so do decisions. And those decisions predominantly rely on our 16-point strategy. One really fantastic stat, I won't read all these because I'm sure people can read, but the one thing that we look at is our ADRs, this top metric here to the left. ADR stands for average daily rate. So we are in our lowest season in terms of revenue in January and February in Fund 1. That's like when the lowest revenue happens. And we're achieving $420 ADRs in low season, right? And in high season, which is going to be like your summertime, basically for us, March through September roughly is like our high season. We're seeing 500s, 700s, 800s. Thousands, right? And that is a testament to both the product we put out, our vertically integrated infrastructure from both property management, project management, revenue management, but also today, I don't think we'd ever operate in a different way. Like, it was a blessing what happened in Fund 1 that allowed us to really pivot and adapt, and that was really great. And I think that's been a really great advantage. And I think that vertical integration really drive shareholder value at the end of the day.
Hey,
It's really
Steve, one question I have for you in that back slide that I, comes up every now and again while we talk about how great the short-term rental space is now. Sometimes investors, they do have this fear of like, well, what happens if things were to fall apart and Airbnb were just to stop? Could you touch base on the long-term rental-friendly aspect of this, just to kind of hit on some of those concerns and fears and how we account for that risk and possibility for our investors?
Yeah, totally. So, a couple things that I want to hit on. If Airbnb was to go down, there are several other ways you can continue to drive bookings and volume, albeit Airbnb makes it a lot easier. And we have to remember that before Airbnb, it's not like vacation destinations and Airbnb homes weren't a thing. Airbnb just made it easy to click a button to do so, right?
Mhm.
So I don't think it's going to go anywhere. Separately, before we would ever go to a truly pure long-term rental, we would test out our theories and underwriting and performance as a short-term rental with lower occupancy, lower ADRs. We would also test out what's called an MTR, or a midterm rental. And these are going to be like for people who are staying there for 30 days to 90 days, right? Or basically less than a year. And people who are stopping by and getting a place to go. And that's even more popular post-pandemic. And most of our homes would pencil as an LTR, but they're certainly not going to generate the type of performance that we're at today. As you might imagine, right? We're driving 3-4 times the traditional revenue as a long-term rental. And we see it. So while all of those may feel like risks, we also want to remember that we're predominantly investing in two types of markets. The first one is where regulation already exists. And the second one is where regulation they can't take away from us because it's been passed as a state bill or those types of things. So the likelihood of those things happening are incredibly low. And we've adjusted those fairly well.
Yeah, appreciate it. Thanks, Steve.
One more,
of course.
while we're on this slide, not to get bogged down, but
Of course.
in the multifamily space, we some of our deals have floating rate debt and things like that. And so a lot of the questions we get from our investors are, how are we financing them and what does that look like? Is it fixed debt? What are the terms? Those type of things? Because in the environment we're in, right, that's kind of a hot topic.
Yeah, I agree. And I'm going to skip right to it, Mitch. So we are hedged to protect the downside and protect capital, right? And debt is arguably, from a financing perspective, our number one advantage compared to multifamily and every other asset class. So in multi, what's very common is at best, you'll see 5-year fixed rate debt, right? Oftentimes you'll see a 3-1-1, which is exactly what Mitch is talking about with floating rate debt, like fixed for 3, variable for 2. And oftentimes they'll take out bridge and then go into variable debt, right? Because they're essentially chasing cap rate compression and pushing rents up, as they say. In our case, all our debt is fixed for a decade or longer, 10 plus years. In fact, 90% of our debt is fixed for 30 years, right? So the advantage there in itself is we're never a forced seller. If rates come down, we can do a rate and term. If rates come down, we can do a cash out refi. If rates go up, we're unaffected. And while we do have a projected 5-year hold, if it's not optimal to sell in year 3, 4, 5, or 6, we can hold it for a little bit longer. And if you look at history, which we are big fans of just looking at history, any 10-year period has historically been fine. What the problem is if you look at something like 2008, everyone who lost their shirt, over 95% of people who lost their shirt in 2008, were two reasons. They had floating rate debt at an inopportune time. That was it. That was the problem. And because they had that, they were forced sellers and they couldn't refi or sell at favorable values because the market took a shit. And we will never be in that position because all of our debt is fixed. And not only is that, none of our debt is cross-collateralized. So in addition to having 75 or 100 homes in a portfolio, each property is its own loan. So if for whatever reason we lost a home, and as the analogy says, you can lose a pinky but still survive, we'll be okay if that was to happen. And of course, our renovation strategy, bringing up these homes up to par, we're adding significant equity as well, right, on purchase and buying them at or below value typically as well. So all of these strategies concurrently allow us to really operate a safer, for lack of a better word, or risk-adjusted return profile.
That's
So
awesome. Thank you.
Yeah, of course. And so, all that being said, this vertical integration, right, that we have and this performance starts with a lot of design and data, right? We firmly believe in tackling an approach that starts with these two things because it tells us that things are working. So this is a really great case study. This is actually a property in our first fund that we all did together. When we purchased it, it had been doing about $145,000 in revenue for the last 3 years as an existing short-term rental. It just wrapped up its first year with us and it cleared over 210. What changed? Better design, better operations, better pizza. I'm just kidding, Papa John's joke. But the idea here is, it's not rocket science. It's just people aren't looking at it the way into the lens that we are, right? We're arbitraging a market where people aren't taking this institutionally because they don't know how and they can't. They don't have the capital. They don't have the infrastructure. We do. We have all these advantages that we can lean on. Or perhaps a grandma's cabin that went from, null and void to really bright and airy because this market demanded this industrial-like feel. Or Barbie's pink house, right? And inspired by Barbie and the pink for bachelorettes and families and communities in our Scottsdale market, this home actually generates one of our highest nightly rates, right, in our portfolio. Now, if you owned just this one asset, you'd probably be hedged a little thin because of this type of novelty type home. But in a portfolio, we own several of these types of homes, in addition to other more stable type products that balance. In fact, I joke around it all the time. It looks like an STR ETF, right? Because you have everything that's like high growth, high risk to low risk, low reward, right? And a little bit of both for that blended and risk adjusted return. You have modern design, stock tank pools in places like Memphis, Tennessee, right? With large yards and family-like activities. Or perhaps modern cabins in places like the Poconos, right? Which is a kind of known as the Big Bear of the East and drivable from DC and New York and some of those other areas. So all that to be said, really great product, really great vertical integration, really great performance in our first fund. But let's talk a little bit about the numbers. Mitch, Austin, walk us through what your fund looks like in terms of options for your investors.
Yeah, so Fund 2, I'd say the biggest difference here is going to be that it's a 506C, so we are looking for accredited investors only. We have a minimum investment of $50,000. Again, the hold period here is that 5 to 6 years that we've talked about. 100% of the tax benefits go to you, right? You are a true partner in the deal, so as we get those benefits, those are passed directly through you. We're planning on the same quarterly distributions as we're seeing in Fund 1. And as Steve said, we're hoping to keep that ball rolling, just cross that $1 million mark. Again, the pro forma projections here are 8 to 12% cash on cash returns over those 5 years, with the projected annual return of about 17+% at the end. Again, right, we're protected by all the things that Steve just covered, right? The 16-point underwriting guidelines, diversification across all the states, things like that. So again, at that fund level, right, we have that 8% preferred return, right? That protects you as the investor. You're going to get that first 8% of all of those profits that we see. After that, right, it's an 85% to you, the investor, 15% split. And again, right, it's 100% passive, right? After you've done your research on the deal and us as GPs, right, and you wire the money, right, you sit back and collect those checks while, us and Steve's team, do all the work. This is just more of a detailed summary of kind of going over exactly what we just said. Kind of goes over, again, the cap, the minimum investments, what we're projecting as far as cap rates, so this is a really cool tool to see, at a $100,000 investment, like what you can project to see. Again, these are just projections, right? We're not fortune tellers. We can't see the future, but this should give you a good understanding of what to expect if investing in the fund. Obviously we're excited that Fund 1 is overperforming, so we do hope that there's a chance for that in this fund. But again, these are our conservative numbers that we want to, at least say this is what we baseline off of while offering this.
Yeah, and I gotta say, you guys negotiated from some really great terms, right? And I think people often ask, or they're curious. They're like, well, why wouldn't I just go invest with Seif and TechVestor directly? The short answer is you're not getting these terms, at least not for that same check size. And so Austin and Mitch can negotiate for better terms like this and pass along those benefits to you as an LP, because as a community, the Bull and Bear Investment Group is writing a much larger check. And because of that, they have negotiation leverage when they take me behind the barn and ask me for some better terms. So all those things being said, right? I highly encourage you guys to work with Austin and Mitch. They're fantastic people. You have direct access to them and everything that they do. And they've negotiated simply better terms, right? So if you're looking at it from a financial perspective, those are some really good options. Tax-wise, Mitch kind of touched on this. Everything is passed along. Of course, none of this is financial advice. You'll get passive losses on your K1, which really just means you're going to show a paper loss, even though you made money. And most people do qualify for this. But for your specific situation, you should talk to your CPA or your financial advisor, depending on how you and your partner, if you have a partner, file your taxes. But for the most part, this is a good thing to take a paper loss because it'll allow you to drive some really great, significant yield. We also have a perk called owner stays. You can stay in any one of our homes because they're your homes too, right? So act like an owner, stay like an owner. You can save 10 to 30% off simply by doing those types of things. And they're all over. You can just simply email our concierge.
Just a heads up here, Steve. You guys have seen a little of the photos here. These things are very popular. So, if you want one, you got to plan accordingly and ahead. We had a few investors reach out like the week of, and we're like, man, these things were long gone.
No.
So,
no, we are, we know our occupancy. They're usually for the next like 6 to 12 months pretty well, and we typically operate in the top 10% of occupancy and performance in the markets that we're in, and our properties are definitely rare finds, especially on short notice. And in advance you can certainly stay on them, but you'll save some money if you do. So that definitely a thing. So we talked a little bit about the cost of debt and our strategy and reducing risk. So I won't touch too much on that, but I will touch on a couple of other things, which is a reminder that we're not in 2008, right? We may be in some sort of weird economic time. I think that's a very fair analogy and fair, reasonable assumption, but it's not 2008. It's not a housing crisis. In fact, supply is lower than it was pre-pandemic. Supply is low. Interest rates are higher for sure, but no one's bringing properties to market. People have significantly more equity in their homes and they're not selling them, right? You have the Dodd-Frank Act that was implemented, Freddie and Fannie that was implemented. There's better lending terms, better credit terms, better borrowers, right? Through and through. So while there may be something that happens in the market, it simply will not be tied to lending infrastructure, even if banks are collapsing. Banks collapsing is not a reflection of the lending industry, right? That's a reflection of risk management potentially, right? And the way that they're handling their books. And that in itself, we are starting to see some price compression in homes, which is allowing us to buy for better cost basis while our revenues continue to increase. That's actually a really great position to be in, right? If prices are coming down, so the same type of home you can buy for less money, but your revenues are going up, your price to rent increases, right? You're pulling this elastic band from both sides. And we're really excited about what's to come because what we've been able to prove in our first fund, it's really hard to compete with us, both on a scalable capacity, on a technology capacity, on an operational capacity. And that makes us really strong and harder to compete with on a daily basis. So for those who do want to get involved, Mitch, Austin, how can they do that, right? They want to join the Bull and Bear community. What are those next steps?
Yeah, well, you took the first step right in watching this webinar. Obviously, our goal at Bull and Bear is to get you at a place that you are comfortable enough with your investments to move forward. Ultimately, we want you to hit your investing goals. And what that looks like is obviously me and Mitch would like to talk to you about what that looks like. But if you get to that place, and one thing we kind of glazed over was the software. And we've got great videos of Steve walking through what that looks like and really digging into it. So there's a ton more assets out there to get you to that place. But once you're there, we're going to actually we're going to send you over the PPM, which is the formal paperwork to sign up. Pretty easy during via DocuSign, super quick. Then you would wire over the funds, and then you're good to go. I mean, that's really it. And then we're off to the races, and then gonna just crush it.
Yeah, and then I think you guys use InvestNext, I believe.
Yep.
And so quarterly reporting. So we use InvestNext as well. So those systems talk really well to each other. So quarterly reporting, those quarterly distributions, you can expect quarterly distributions roughly about 6 months after investing is a good range. And usually about 30 to 45 days after the close of the quarter, because we got to close out our books, accounting, CPA stamp and all that kind of good stuff. And here's a little bit about what that portal looks like. You can see exactly what your balance is, what your distributions look like, all your updates. right? And as a reminder, everything we're doing here is infinitely scalable, right? Whether it's buying one, buying 1,000, whether you want to reinvest and grow. If you invest with Austin, Mitch, and Bull and Bear tomorrow, and 6 months from now, you want to increase that investment size, you can do that, right? This offering is a really fantastic opportunity for that level of scale. So fellows, thanks again for inviting me on today. Really excited for round two. I think this is going to be a even bigger and better opportunity for many people. Any last remarks here before we hop off?
No, great job. Thanks for joining us.
Yeah, appreciate it,
Yeah.
Steve. And thanks for everyone for tuning in.
Of course. Thanks, everybody. Bye.